Hello and good morning, everyone. Welcome back to Almus Market Mornings, those of global financial updates with me, Swaraj. Well, the narrative of who can outhawk the Fed is quickly turning to who will outdog the Fed first. We had the Bank of England Governor Andrew Bailey hinting rate hikes may be near the end as the central bank expects a marked reduction in inflation this year. Adding to the dollar bull's cheer was the ISM Services PMI reaching its highest monthly reading since February. For rupee, global factors remain negative, rising oil prices, weak yuan, and a broad dollar strength. Let's hear from JK his thoughts on the markets right now.
Good morning, Swaraj. Yes, we after a quiet Tuesday and a holiday on Monday, we had a few important indicators yesterday, which actually starkly showed up the difference between the state of US economy and the Eurozone. The German industrial orders fell more than expected at minus 11.7% versus minus 4% expected. And the weakness was driven by the global economy that was, slowing down. Although on a 3-month average basis, it was not so bad. On the other hand, ISM services, as you said, beat expectations, coming strong at 54.5 versus 50.5 expected. And then all the components were stronger. Employment at 54.7, prices paid at 58.9, and new orders at 57.5. And if you compare this with the S&P Global Eurozone Services PMI, that was into contraction territory at 47.9. So that's the current theme that's actually driving the dollar up. And of course, the yields have been another story. Eurozone yields, of course, yesterday caught up a bit after the ECB member notes quite a hawkish statement, and he said that market may be underpricing the possibility of a hike in September by ECB, and that actually put a floor under Eurozone yields as well as the euro currency above 1.07. So that's the reason why we are finding euro somewhat in a stable range right now. So a lot of interest now surrounds the ECB meeting coming up because they have economic slowdown, but the possibility of inflation remaining sticky is high because even the recent crude oil prices would add to the inflation. So ECB is generally known to be an inflation hawk. So don't rule out another supportive bounce from the euro until at least the ECB meeting is over. Of course, we did have EOS yields also responding in a mixed manner yesterday. 10-year was rising just by 3 basis points, while the 2-year rose strongly by 6 basis points. And this was on a slightly increased expectations of hike in November. September, of course, at 92% probability. November is still below 50, but it is just rising after the inflation number. But slightly, on the other side, Beach Book, which is usually published before the Fed meeting, showed that US economy and job markets had slowed in July and August, and many businesses expect wage increases to ease broadly in the near term. Now, the higher for longer and Fed fund rate being at 5.5%, inflation pressure possibly getting sticky led to the stock market sell-off yesterday. It was the 4th day of fall in the US markets. All the 3 indices were down, and the global index was down by 0.6%. The technical momentum indicators do show some more downside for the markets. Of course, we need to look at some strong clues from the central bankers and the economic. We don't have too much of big data this week, but we will have the inflation numbers next week. That should give a better clue for the markets. Now, on the FX, of course, the fallout of the bigger rise in euro yields saw the euro being resilient, as I said, above 1.07, but the GBP was hit by comments from the BOE Governor Bailey that UK rates are near the peak, and possibly a marked drop in inflation this year is very much likely. And he said much of the surge in the key rate to 5.25% from 0.1% at the end of 2021 is yet to be felt by the economy. Staying on the central Bank of Canada was unchanging their policy rate as expected, but with no fallout on the Canadian dollar. And the bank also indicated willingness to tighten again on underlying inflation concerns. And this is the common theme that's running through all the central bankers. They are now pausing, but they are not ruling out more hikes if the data demands it. Now, on the rupee, There were no fresh negatives, of course, but the markets is still trying to price in the recent adverse developments for the rupee's value, and it is getting closer to all-time lows against the dollar. Now, of course, we are seeing consistent selling from central bank, who would definitely be keen to avoid a breakout from 83.30, because that would lead to a swift fall in the rupee's value, and inflationary impact of the further weakness in rupee, even as crude oil is strong, or rather above 90, is something that would be behind the central bank's actions. So somewhat of a nervous range trading is what I expect between 83 and 83.25 today. Central bank's actions will be closely watched. Yeah, I think we may need some more triggers before we can see the next big breakout. Till then, a range trading should prevail. Thank you.
Thank you, JK. And as you mentioned, on the European front, data was not that good when it comes to the German industrial orders, which came in at 11% versus -4 expected. And on a contradictory or a more stark different side, ISM services in the US beat expectations and came in much stronger. And if we compare the services PMI number of the Eurozone, that was well into the contractionary zone. We have the upcoming ECB meeting. So the challenges they are dealing with is the economic slowdown plus the sticky inflation. And now the rising energy prices will again put pressure on inflation. So it's possible for a small bounce in euros, since ECB are known inflation hawks, as JK mentioned. Yesterday, we had the stock market sell-off in the US as higher for longer narrative for the Fed gets cemented in. Bank of Canada rates remain unchanged, and for rupee, as we are getting closer to the all-time lows, there is a nervous range trading between 83 and 83.25. That's it from us today. Tune in tomorrow as we discuss the latest in the financial markets. Thanks for listening.